to do it. There, how we doing? Good, everybody's good. Yay, Anna says hi. All right, so even though I'm not on campus, I wanted to let you guys know that I am still representing. I got my William Woods sweatshirt on. And in addition to that, I am drinking out of my William Woods cup there. So I am there in spirit. Nice. All right, just one more minute and we'll get started here. Of course, I'm coming to walk into class and Chloe's like, I'm hungry. I'm like, well, you're going to have to wait now, sister. Hi, Brendan. Hi there. Okay, can everybody hear me okay? Yes. It is 1 o'clock, so we are going to go ahead and get started. So I have an Excel file prepared for us to do together. You guys don't have to take notes or worrying about trying to write anything down while we're going. Just pay attention to the screen, because when class is over, I'm going to send you the Excel file with the answers. And so you'll have all the notes and all the answers and everything. This is actually this Excel file, excuse me, is actually in Brightspace under Unit 2. And it just says Chapter 7 Excel exercises. So that's the one that we're working on together. But like I said, when we're done today, I'll send this out in an email to everybody. So you guys will have the notes and you'll have all the answers. So you don't need to try to take notes or write anything down while we're on this Zoom call or this Zoom class together, because I'm going to send it to y'all anyway. So let me share my screen with you and I'm going to get this Excel file pulled up. Okay, so what I want to do is I want to add a blank sheet here real quick. And then I want to take some quick notes. So I did tell you guys already that we were going to be going over notes receivable, right? And so remember, notes receivable, similar to accounts receivable. Notes receivable are an asset. We could have a short-term notes receivable, notes receivable that we expect to collect, you know, within the next year, right? Or we could have a long-term notes receivable. In that case, we're not going to collect it for longer than a year, right? Or over a year. So a couple notes that I want to take again out of our book. So, you know, again, when we're thinking about notes receivable, notes receivable is a more formal contractual agreement between a company and whoever is signing the note with them, right? So I remember, just for example, and I don't know if William Woods has anything like this, but I remember when I used to teach at the former institution that I was at, they used to offer promissory notes to students who received tuition reimbursement from their company. So basically, the student would sign a promissory note agreeing that they will pay the full amount of tuition, you know, within 30 days after the class ends, once they get tuition reimbursement from their company. So I know, you know, they used to use notes receivable in that capacity. As we're going to see in some of our exercises, you know, we could, as a company, we could sell products or services to a customer, and we could accept a note for their payment terms, right? Or when we're thinking about in our personal lives, if we take out a car loan, to us, that's a car payment or a car note that we have to make. That to us, that's a liability. But to the company that loaned us the money, for example, GMAC credit, General Motors credit, or Ford Motor credit company, right? Whoever loaned us the money, that's a note receivable to them. So just to give you kind of an idea about that. And then just like it tells us in our book, we could have an interest-bearing note, right? Interest-bearing note, which in that case, interest is stated, which just means explicitly stated, right? Interest is stated in note agreement. For example, it might say, 8%, right? Example, on the note, it might say 8% interest or 10% interest, whatever, right? A stated interest rate. That would be an interest-bearing note. Or on a zero interest-bearing note, zero interest-bearing, zero interest-bearing note, interest is not stated. Interest is not explicitly stated, right? Is not explicitly stated. For example, 8%, 10%. Rather, right? Rather, interest is built into the face amount. Interest is built in to the face. Built in to the face amount. So again, we'll see an example of that, built into the face amount. Okay, that's the zero interest bearing note. So, on a zero interest bearing note, again, we're going to see an example of it. But basically, we might accept a $20,000 note, but when the people pay us back, they have to pay us back $21,000. So, that is a $1,000 interest, right? It's built into it, essentially. Okay, and then the last thing that I want to talk about. So if note, I'll just put NR, if note is less than 1 year, if note is less than 1 year, we do not have to calculate present value. We do not have to calculate present value of future cash flows. Present value of future cash flows. Right? If the note has a maturity of less than 1 year, we do not, right? We do not have to calculate the present value of future cash flows. However, if the note has a maturity of greater than a year, right? So if note receivable is greater than 1 year, we have to calculate present value. Present value. So if note is greater than, if the maturity of the note is greater than 1 year, we have to calculate present value. And similar to what we saw with bonds, this present value has two components. Present value of the principal amount, and then present value of interest. So again, we'll see examples of that. Okay, so I'm going to put here, I'm going to rename this because I'm going to send this to you guys. This is note receivable notes. Note receivable notes. All right, and then let's take a look at a few of these together. So here is our first one. actually, let me scroll back up here. Here is our first one. So this is brief exercise 7-7. This one says Milner family, and I can try to blow this up a little bit more so we could see it as big as possible here. This is out of our book. So it says Milner family importers sold goods to Tongue Decorators for $30,000 on November 1, 2020, accepting Tongue's $30,000 6-month 6% note. Prepare Milner's November 1 entry. So that's when we sold the goods on November 1. The December 31 annual adjusting entry, on that one, we'll want to record any interest revenue. And then on May 1 for the collection of the note and any remaining interest revenue is what we're doing with this one. So on this one, okay, November 1, we need to record the note. So November 1, we accept a $30,000 note in which we sold goods to a customer. So we would debit notes receivable. And again, this is a 6-month note. So we do not need to calculate the present value, right? Since it's less than a year, we're not calculating the present value of future cash flows. So we just need to debit notes receivable for $30,000, credit sales revenue for $30,000. That's what our entry would look like to record the sale. All right. But now we get to the end of the year, we get to December 31st, and we have to recognize, even though we haven't collected on the note and the interest for the note, right? We have to recognize that we have earned some of the interest. They've owed us the money now for 2 months, right? They owed us the money November, they owed us the money December. So they've owed us the money now for 2 months. We have earned some of that interest revenue, even though we haven't received it yet. And by the way, let's do this real quick. Let me show you for the entire 6-month note. Remember, we can think about interest expense, like, or interest revenue in this case, as the principal times the interest times the time. Principal times interest times time. That equals, in this case, our interest revenue, because we are the one accepting the note, right? The one owed the note, the maker, if you will, of the note, right? And so if we plug our numbers in here, okay, 30,000 times, this is what, a 6%, so 0.06 interest, and I put plus, hot dog, Jesse, times 6 out of 12. Because again, this is a 6-month note, so they're only going to owe us interest for 6 out of 12 months. So if we plug the numbers into our calculator here, 30,000 times 0.06 times 6 out of 12 months, hot dog, 30,000 times 0.06 times 6 out of 12 months. This is going to be total interest revenue of $900, right? But again, at the end of December, we've only had 2 months worth of interest, okay? So we've only earned in the amount of time, we've only earned 2 out of 12 months worth of interest, right? So in that case, again, we take 30,000 times 0.06. So in that case, for 2 out of the 6 months, we've only earned 300 at December 31. Does that make sense? Hopefully. So at December 31, when we do our entry here, we have to recognize that amount of interest. that we have earned. We just haven't received it yet. So we're going to December 31st. We're going to debit interest receivable. I'm not sure why it's doing this red on me. Debit interest receivable for 300. And I'm going to put in parentheses so we remember. That's our 30,000 times 0.06 times 2 over 12 months. And that gets us equals 30,000 times 0.06 times 2 over 12. That's our 300 interest receivable. I don't know why it's doing that red. Okay, we haven't received that yet. So credit interest revenue. Again, for the amount of revenue that we haven't received it yet, but we have earned that interest revenue. Does that make sense so far? Okay. Okay, and then on May 1, when Tongue Decorators pays us back, right? So this is May 1 of the following year. We are collecting on the note and the interest, right? So remember the total amount of interest over the course of 6 months, that's the 900, right? We have recorded 300 of that already, right? Now they're paying us the entire amount, not only the $30,000 note, but the entire amount of $900 interest. Okay, so we're going to debit cash for, again, I'm going to put on here, not only the principal amount, the 30,000 plus the 900 worth of interest. Okay, so they're going to be paying us cash total 30,900. And then we need to debit excuse me, so credit, hot dog, credit notes receivable. They're paying this off now, so crediting notes receivable for 30,000. Credit interest receivable, because again, they're paying this $300 from December. They're paying that off. We're receiving that. And then credit, and I should have put an additional line in here. And then credit interest revenue for the 600 in revenue we haven't recorded yet. So that's what that would look like. So again, this May 1, so this is to record the payment of the note, right? When the customer pays us back, basically, right? So that's where we've got our debit to cash for 30,900, credit notes receivable for the 30,000, credit interest receivable, because up here on December 31, we had recorded the 300 in interest that we had earned so far, and then credit interest revenue for the remaining amount. Okay. Any questions about this one so far? So this was an interest-bearing note, right? This was an interest-bearing note. We can see that right here because the interest was stated. Interest-bearing note. The interest was explicitly stated in the terms of the note or the note contract, right? Now we're going to look at one that is a zero interest-bearing note, but we're going to see zero interest-bearing notes. They still charge interest. It's just lumped into the face value, essentially. But any questions about this one? Is that looking okay? Okay. Let's look at this next one then. So now this is brief exercise 7-8. This one says Dold Acrobats lent $16,529 to Donaldson Inc., accepting Donaldson's 2-year 20,000 zero interest bearing note. The implied interest rate is 10%. Prepare Dold's journal entry for the initial transaction, recognition of the interest each year, and the collection of the 20,000 at maturity. So really what this one is doing is that we're already, essentially discounting this note, right? Because they're going to pay us back, Donaldson, they're going to pay us back 20,000 when they pay back this note. We're only giving them 16,529, right? So we've really already discounted it back. We've already taken away the interest, right? So on this one, okay, so for the first transaction, to record the initial note, right? To record the initial note transaction, and I'll be a little bit more specific, note receivable transaction. Our journal entry here, right? We would have debit, notes receivable, when they pay us back, they're paying us back 20,000. So we debit notes receivable for 20,000. We're going to credit the discount on notes receivable for the difference between the amount of cash we're paying and the amount of cash they're paying us back. So here, let's leave that there for a second. We're going to credit cash, right, for the amount of cash we're giving up. We're giving up 16,529. That's how much cash we're lending them. So again, that discount, what is going to be our interest, is the difference between the amount of cash we're giving up and the amount they have to pay us back. So this is the 20,000 that they're going to pay us back minus the amount of cash we're giving up. So that discount on notes receivable, 3,471. So again, this amount is representative of the interest charged on loan. Interest charged on note, and I'll just put in parentheses, AKA loan. That's what we're doing. We're loaning these people money and they're paying us back, right? Okay, so that's the initial note receivable transaction. Now, when we record our first year of interest, right? So interest after year one, and I'll do the numbers here. So when we record our first amount of interest, we're taking the 16,529 they owe us, or that we lent them, right? The 6,529 that we lent them, times the 10% interest. That's the amount explicit in the, implied interest rate. Let me highlight that up here. Oh, and of course I can't do that when I'm entering this in, but this would equal 1,000, $653 if we round up, right? And again, it tells us that up here, and I'll go back up here. I'll highlight it real quick. The implied interest rate is 10%, right? And so our interest after the first year. Now, when we first accepted this note, we credited the discount, right? As we are amortizing this, as we are recognizing this interest, we're going to do the opposite. We're going to debit the discount. So we debit discount on notes receivable for 1653. We credit interest revenue. $16.53. So, you know, again, when we're up here and we record the initial note transaction, we haven't earned any of this interest yet, right? We credit discount on notes receivable. We haven't earned any of that 3,471 on interest yet, right? But now we get to the end of year one. And so now we have earned a little bit of it. So we're reducing that discount. We're debiting the discount on notes receivable. We're crediting interest revenue again for that amount that we have earned, right? And then we would do the same thing after year two, right? So interest after year two. Except for now, okay, now we instead of using oh goodness. Now, instead of using 16,529, which I didn't mean to highlight that, I meant to circle it here. Now, instead of using this, now our carrying value of this note, so 16,529 is what we started at. And then after year one, we amortized 1,653. So the carrying value of this note, and I'm getting out my calculator here, 16,529 plus 1,653. Now the carrying value is 18,182. Carrying value. Okay. So now our interest, and again, I'll put it up here. We're going to take that carrying value, 18,182, times 0.10, the 10%. And so this time we're going to get interest of what, 18, let's see, 1,800, oh, good grief, where am I at here? Yeah, $1,818, right? If we round up, in this case, we wouldn't round up, only 20 cents, but so that would be our amount for interest after the second year. So same entry, we would debit the discount on notes receivable, 1,818. We would credit interest revenue, 1,818. Okay. And then when they pay us off, right? When and I forget what their name was, Donaldson. When Donaldson pays us off, then we would debit cash, 20,000, credit notes receivable, 20,000. And again, our carrying value would be at 20,000 at that time, because if we take our initial, I'm just going to erase this so I can show you the math again. So if we take our initial 16,529 plus then we amortize the interest. We charged interest of 1,653 year one. And then we charged interest of 1,818 year two. So now if we add all three of these amounts together, I'm getting out my calculator here. 16,529 plus 1,653 plus 1,818. That's our entire $20,000, right? That was the interest charged. Are we okay with that? Okay. Let's do one more of these. And then also on this one, I'm going to fill out the amortization schedule. This amortization schedule we use a lot. For example, we use this when we get to bonds payable, notes payable, transactions as well. So we're going to see these amortization schedules again. But let's look at this one. So this one out of our book, this is problem 7-8. And so this one, it says on December, oh, why it's not erasing that, that's okay. On December 31, 2020, Oakbrook Inc. rendered services to Behung Corporation, Beghun, whatever, Corporation at an agreed price of $102,449, accepting $40,000 down and agreeing to accept the balance in 4 equal installments of $20,000 receivable each December 31. An assumed interest rate of 11% is implied. Prepare the entries required of Oakbrook Inc. and complete the amortization schedule. Okay, fine. So we're doing this deal. We're making this deal December 31, 2020. Okay. Oops. 12/31/2020. And at this time, the carrying amount of the note is going to be the $102,049 minus the $40,000 down. So basically, they owe us still $62,049. And again, they're going to make 24 $20,000 payments, right? So they're going to pay us, again, if we take 20,000 times the 4 payments, right? 4 equal installments received at the end of the year each year. They're going to pay us 80,000 minus our carrying value. We're charging them interest of, right? If we look at this, they're paying us 80,000 for a note 62,049. Basically, we're charging them 17,951 in interest over the course of the 4 years, right? That's going to be our interest revenue over the course of the 4 years. Okay. So now we get to December 31, excuse me. Now we get to December 31, 2021. And now they're paying their first payment, 20,000. Okay. Of that 20,000, right? The interest revenue, and we're using the 11% for this, right? So if we go back, we're taking our interest revenue is going to be equal to the 62,049, and here maybe I'll just type it in, 62,049, our carrying value, times 0.11. That's that 11% implied interest rate. Okay, so that is interest revenue the first year of 6,825. And so the discount we're amortizing is equal to the difference between cash received minus the interest revenue. So this first year, that discount amortized is $13,175. And again, every time we amortize a little bit of the discount, right, it's reducing our carrying value. So we say equals our 6249 minus that discount amortized. So now we're down to 48,874 that has not been amortized yet. Okay, so let's look and see. Now we get to the end of the next year, our second payment, 2022. Now they're making another payment to us of 20,000. Again, interest revenue, we go to our carrying value. So carrying value times 0.11. So our interest revenue is 5,376 in year 2. That discount amortized is the difference between our cash received minus the interest revenue. So we're amortizing 14,624 of that discount. So we're going to say, okay, equals 48,874 minus, oh, hot dog, minus that discount amortized. We're down to 34,251. Okay. Now we get to year 3, 12/31/2023. They're making another $20,000 payment to us. Again, interest based on that carrying value. Carrying amount now is 34,251 times that 11% interest implied. Interest revenue 3,768. Discount amortized, difference between their $20,000 payment and the amount of interest revenue. Okay, and so now we're amortizing 16,232. If we take our 13,000 minus 16,232, right? That gets us down to 18,018. So finally, our fourth payment that they're making to us, December 31, 2024, they make another payment, 20,000. Interest revenue, again, based on that carrying amount. So interest revenue is the carrying amount times 0.11. Discount amortized, difference between the cash we received for their payment minus the interest revenue. So we've got discount amortized 18,018, which again is now going to take our carrying value down to 0. We've amortized the entire amount. We've collected all the money, not only their payments that they made on the principal, but any of the interest revenue that we claimed, right? We've amortized the entire amount. And we can look here, we can add up these columns. So I'll do it over here, actually. We'll do all of them. So equals the sum, D12, right? So 80,000 total in payments they made to us. If we populate this formula, to the columns we needed, right? We can see that, where is our bottom border here? We can see here's the total interest revenue that we were charged them, right? We amortize the discount amount that they initially owed us, total payments of 80,000, right? So we can see that. Now, it's really easy now to do the journal entries when we're looking at this discount amortization schedule. Because, for example, on December 31, when we initially accepted the note, right? December 31, we initially accepted the note. We would have debited cash for $40,000. Remember, they made a $40,000 down payment. We would have debited notes receivable for the entire amount of the note they were going to pay us back, $80,000, right? That's the 4 payments of $20,000 each. We would have credited discount on notes receivable for the amount of that interest that we were going to amortize over the life of the loan, $17,951. And then we would credit service revenue, excuse me, not cash in this case. We provided a service revenue for the entire 102,049 worth of services. And again, we've got 120,000 on this side. If we go over here, we've got 120 on that side, right? 2 debits and 2 credits. Okay, so that's our, when we initially accept the note. Now, December 31, to record the first interest payment, we would, I wish I would have put here, let me move this date up here so it stands out a little bit, 2020. Now on this first entry to record our first year, we're looking at these numbers, right? We're looking at the 2021 numbers. Okay, so to record this first interest payment, then we would debit cash for 20,000. That's what they're paying us, 20,000. Let me zoom out of this a little bit so we can see it all at once. Okay, so we're debiting cash. They're paying us cash, right? We're crediting, excuse me, we're debiting cash. We're crediting notes receivable for 20,000. That's to record the payment, right? And then we have to record the amortization of the interest. So we're debiting discount on notes receivable. What was our discount this first year? Let's see. The amount that we amortized this first year, $68.25, crediting interest revenue, $68.25, right? That's what our payment would look like. And it's going to look like this every year until it's paid off, right? So now if we go to the next year, December 31, 2022, we would still have this, right? We could copy this, we could paste that. We would still have their payment, and we would still be debiting the discount, crediting interest revenue. We could copy and paste those. Uh-oh, I don't know what it's doing here. Copy. Right? Those 2 accounts would still be impacted. But now we're using our second year, right? Because now we're in 22. So we're using this 5376. So now we've got 5376 to revenue. So we would do that every year, right? Until the note was paid off. All right, let me zoom out of this a little bit so we can see the whole thing. And that's okay. We got time. We'll go ahead and finish it up. So 12/31/23. Again, we'd be doing this entry to record their payment to us of 20,000. So I'll copy that. I don't know why it doesn't want to paste it for me, jerk. Yeah. Trying to make it go a little bit faster since we're running out of time here, and it doesn't seem to want to cooperate with me. All right, so we'd still do that entry, right? And we're still going to debit and credit, debit discount on notes receivable, credit interest receivable. But now we're going to do copy. Good grief, Jess. Paste. But now we're going to do the amounts for 2023, 3768, 3768, right? And then the last year, December 31, 2024. Again, very similar transactions. Copy, paste. We still got the debit to cash for 20,000 they're paying us. That reduces that $80,000 note. And then the amortization of the interest. So this year, 1982. 1982. All right, so there's the whole problem. That is problem 7-8 out of your textbook. All right, hopefully feeling okay with notes receivable. Like I said, we're going to get some more practice with this amortization schedule when we get to like notes payable, bonds payable, long-term liabilities. We use these amortization schedules as well. So we will see these again. So hopefully that's making okay sense to you. But while I've got this pulled up, any questions about the notes receivable transactions thus far? Okay. One more thing, we didn't get to it today, but I did have a bank reconciliation problem picked out here. This is actually a bank rec problem from your Principles of Accounting textbook. And so if you feel like you need to review bank reconciliation, then you can do that. We got a lot of practice. I know all of you should have gotten a lot of practice with this in Principles of Accounting. So I usually don't waste too much class time on it, going over it again. But I added it on here just in case we had extra time, which we didn't. But if you guys wanted to review this, bank rec and petty cash is another thing talked about in chapter 7. But again, we covered those things thoroughly in Principles, so I usually don't spend too much time on them. The allowance for doubtful accounts, calculating the bad debt expense, the notes receivable, that is what is new information for us. That's what we focused on. But if you would like to just, go through and refresh your skills on there's that problem for you. Anyway, any questions about any of this while we've got it pulled up? Okay. All right, well, I'll stop sharing my screen. Like I said, everyone, I'm going to send out this Excel file with all the answers when we're done with class. And then I'll also send out the recording to this Zoom meeting so that if you wanted to watch any of the calculations again, you're more than welcome to do that. But have a great fall break. So remember, we don't have class on Monday. That's fall break. So then we'll be back in the classroom together next Wednesday, okay? All right, bye-bye, everybody. Bye-bye. Anna gave me a wave. Yay, bye-bye.